Well, the August jobs report is released on Friday. Economists expect non-farm payrolls to rise by 175,000. And here with a preview is Emanuella Enenajor, a senior economist of North America at Bank of America, Merrill Lynch. So, Emanuella, what's Bank of America's base case for the August report?
So we're looking for 180,000 jobs created in August, which is roughly in line with the consensus view. Would be a bit of a slowdown from the last couple of readings, but it would be more in line with the 6-month trend.
Well, and I want to put up this chart basically showing non-farm payrolls growth over the past year. That's the orange line, and then the red line is the average over the past 3 months, which is 190,000. And this chart just screams volatility, right? So what number do we need to see in the August report to make the Federal Reserve comfortable in raising rates following its September meeting?
Well, I think that, there's no magic number, and the Fed is looking at a variety of indicators in this report. So they do care about the change in employment, but they also care very much about measures of slack. So they'll be looking at the jobless rate. We think the jobless rate will tick down by 1/10, but if we see a decline in the jobless rate, if we see wages heading higher in terms of the year-on-year trend, and if we get a good number, a solid number, let's call it, mid 200s or so, I think that's enough to get the Fed to believe that this jobs recovery is continuing. Whether it means a September or a December hike, I think that's a little bit more of an open question. But we still think that they go in December at this point.
But certainly if we get a 5-figure reading on Friday, one would think September is off the table.
I would say most definitely a 5-figure reading would be somewhat alarming. We've already had some weak data points. If you look back, I think perhaps on your chart it may show that we had some very, very weak numbers in the late spring, early summer. So we've had a lot of volatility in the data, and we want to see strong data in the August report to confirm that weak spell was only temporary. If we get another really soft number, I think it raises questions as to just how strong this labor market is going into the fall and into the winter.
All right, now you mentioned wages earlier. Let's dive deeper into that. Wage growth is expected to drop slightly in August. Analysts are expecting, a 0.2% increase in August compared to a 0.3% increase, which is what we saw in July. It is a volatile number, but it's certainly to see growth sort of soften, that doesn't bode well for the inflation part of the Fed's mandate, right?
Well, I wouldn't be too cautious on wages. Look, we're looking for a 0.2% month-on-month increase, which is sort of in line with the broader trend. Yes, the year-on-year rate is going to slow down, but some of that has to do with base effects because we're comparing it to another point a year ago, which also impacts the rate. If you look at wages more generally, if you look over the past 2, 3, 4, 5 years, you will see very clear evidence in average hourly earnings that wages are gradually accelerating. Now, we've done a report, you look deeper in the wage data, and you see that a lot of low-pay sectors are seeing stronger wage gains, which is encouraging. But bottom line is, I think you are seeing wages strengthening. It's gradual, but it should be encouraging for the Fed.
All right, and finally, before we let you go, anything to say about the labor force participation rate? It's at 62.8%. Up from 62.4% a year ago. Now, it's been on the rise this year, although if you look at a 12-month chart of that, it's been very volatile.
That's right. So I would say that, the increase in the part rate, yes, it does put some upward pressure on the unemployment rate. Yes, it does mean that perhaps there's a little bit more spare capacity, if you will, than what we had before. But I think the important takeaway is that if we're seeing the participation rate increase, it means that the labor force is growing. It means that more people are participating, so to speak. And it's a sign that the labor market is healthy, that some of these discouraged workers are coming back into the labor force. So on the whole, it may mean that perhaps slack is a little bit greater, but it's the right kind of sign in terms of the labor force health. So I would say we'd focus on the part rate, but we look at the broader metrics for this report as well.
All right, we'll be watching all of this on Friday. Emanuella Enenajor from Bank of America Merrill Lynch, thank you for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.